Private forecasters have flooded us with a bewildering range of GDP estimates for the year. Minus 5.2% GDP estimate from Nomura to minus 2.6 from CLSA to flat estimates from Citi. But what's more bewildering is that there are no estimates at all of India's GDP, real GDP from the Reserve Bank. The Reserve Bank hasn't given us a real GDP forecast, and the government has not given us a nominal GDP forecast. Of course, the government has given us a new borrowing number, but we have no idea how much of this is due to lower tax estimates, how much due to expenditure compression, and how much is intended for fiscal support to the economy. While the government's silence on estimates may bog down financial markets, it is the silence on the steps to help the economy that is agonizing the entire swathe of economic actors. Today, we have an elite panel of economists and financial sector experts to answer some of these questions. One, how are they arriving at their measure of economic growth? Two, is the government right in fighting shy of giving any estimates altogether? Three, how should the markets negotiate this uncertainty? What explains the near absence of any fiscal steps from the government? Should the government worry too much about rating agencies? And finally, the financial sector piece. Isn't it time the RBI and the government make some announcements about how to bolster the financial sector? I'm joined by some elite economists. Anantha Nageshwaran, he's a member of the Prime Minister's Economic Advisory Council and a well-known financial sector expert. Samiran Chakravarti, Chief Economist at Citi. Sonal Verma, the Chief Economist, India and Asia ex-Japan at Nomura. And Hitendra, the head of Global Banking and Markets at HSBC India. Gentlemen and Sonal, thank you very much for joining me. Sonal, I have to come to you first because your estimate of the GDP contraction kind of made everyone sit up. Minus 5.2, how do you arrive at that kind of a figure?
Hi, Lata, good morning. So, of course, there's a lot of uncertainty, but a few assumptions that have gone into our projections. I think number one is the peak impact that we will see in Q1 FY21. And the data we have so far clearly suggests that depending on which sector you're talking about, activity is down between 10 to almost 0% growth in the auto sector, for instance. In April, half of May has gone by, but on average, to our mind, Q1 is going to see, on average, activity being down between 40 to 50%. This is an aggregate. In terms of translating this into a gross value addition number, our assessment is this particular quarter, GDP will be down about 15% year over year. Second is, how the economy pans out thereafter, because I think that's where there's a lot of divergence between forecasts. And I think, to our mind, it will be hard for the economy to revert back to normal that soon. You do have more than 30% of India which actually resides in the red zone districts where consumption demand will remain quite weak. In districts where activity is opening up, there will be supply chain challenges. You have global demand, which is down quite significantly. So both US and Eurozone, we're looking at more than 8% contraction in GDP growth this year. So the impact of weaker external demand is still to feed through. And I think finally, just in terms of the knock-on effects on India itself, what we've already seen is that the big cash flow impact on companies is forcing them to, in some cases, announce fixed pay reductions. Companies are cutting down their capex. There are a lot of workers who will not be able to actually get their job back. So unemployment rate is picking up. And the knock-on effect on the banking sector in terms of higher NPAs, what does it do to availability of funding? Lower rated borrowers and therefore their final demand. And I think that's the sort of knock-on effect that in our mind plays out in the second half of FY21. So on aggregate, we think growth will end up being close to 5% below last year's level.
What would therefore the nominal GDP growth fall be?
Lata, I mean, given the nominal takes sort of a weighted average of WPI and CPI as a proxy, where you do have higher CPI because of food, but WPI should see a big decline given commodity deflation. The aggregate nominal GDP growth, in our view, will also be negative, but somewhere between 0 to -5%.
Okay, so we are looking more like 190 trillion, 190 lakh crore economy. Samiran, your estimates are not so negative.
Yeah, I mean, it's a difficult times. So first, we have to make a couple of assumptions.
Hasn't changed yet?
So the first assumption that we are working with is that the spread of the virus will be such that the peak of the daily cases would be somewhere in the May 20th to May 31st, that sort of a period. And we are not going to see a second wave of the virus coming.
Okay.
The second assumption that we are making is that in whatever sector we look at, if to the extent the demand comes back, ramping up supply to meet that demand will not be an additional constraint. And the third assumption that we are making is that the demand outlook will be somewhat insulated because the job losses in the organized sector will be relatively less than the job losses in the unorganized sector. And the organized sector is bulk of consumption, so consumption will probably be less negatively impacted than some of my peers would probably think about it. So under these three assumptions, we are thinking of a decline of about -7.3% in the first quarter, and then probably as things normalize, and this is very important that this is a very different kind of shock, where when the shock is also very large, the normalization process from this shock will also be somewhat automatic as the economy opens up. And the last point that I want to make is that we need to make a difference between the value add and the volume very distinctively in these setups like this.
Okay.
The volume growth will fall much more than the fall in value because everyone will do a significant amount of cost optimization, which will make the value fall less than the fall in the volume. So because of that, we probably have a slightly higher number than someone else.
Okay, which is what? I mean, you are at 0.5%, right? Or 0.4% when we last spoke. Positive, right? Growth of 0.4%.
0.6.
0.6. Okay. Well, Anand Nageshwaran, you know, what I wanted to ask you is, should the government fight shy and the RBI fight shy of not giving any numbers? I mean, is it not always better to have some kind of a guiding post which can always be revised later on? This complete vacuum of numbers isn't, is that advisable?
Which number are you talking about?
We don't have, we don't have a real GDP number from the Reserve Bank. We don't have a nominal GDP growth assumption from the government after it announced the borrowing program. We don't have, why was the borrowing program changed? How much was the tax reduction estimate? Those are the kinds of estimates, goalposts I was looking for, which we don't have.
I understand that all of us would psychologically feel more comfortable with some numbers because that gives us something to grasp and then figure out what the actual would be in terms of the deviation. But probably that is a little bit more honest than the kind of precision, false precision that we are all having right now, talking about first or second decimal point precision in terms of GDP growth, etc. I mean, how can you have a tax to GDP ratio if you have no idea where the denominator is going to be? So I think while I understand human psychology wants to have something to grip, it probably is not, to me at least, not such a big disaster that you don't have an estimate. And governments in India in the past, if you look at the budget numbers, the nominal GDP assumption would be there in the footnote to the budget at a glance. It was, I mean, we have not had the kind of assumptions nicely listed in a table, which should be there, of course, that the government has used in arriving at the numbers. Most of the time, analysts used to figure it out themselves, and that probably is the exercise that we are doing. So in that sense, this is probably business as usual.
Well, not quite, sir. I mean, we have been very seriously investing in a very elaborate economic survey on the day ahead of the budget. And about few weeks before that, the CSO gives its advance estimates for the full year,
That's right.
although it is belaboring with only 7-8 months data. So we we do try to put in some kind of numbers. At this point in time, not giving any numbers, at least the government could have given some kind of the assumptions it went with for the borrowing program, you think? That would have helped?
I think it is definitely nobody's case that we should not have numbers. So I would any day opt for more transparency rather than less. So in principle, I'm agreeing with you. All I'm trying to say is that in the past, also along with the budget exercises of the government, you mentioned CEA, you mentioned the CSO. Yes, those things they have been doing that.
Yeah.
But from the government per se, we never had a very easy to grasp set of assumptions that went behind the budget numbers. Most of the time we used to figure it out ourselves based on the numbers.
Yeah.
And that's what I said. So I said in that sense, marginally speaking, there is no change. That's what I'm trying to say. It is not as if we went from greater transparency to lesser transparency. It is just status quo.
Okay. I would argue that things were a little better when it was business as usual, but in this unusual situation we could do with some more help from government, and government has excellent people working for it. The CSO could be asked to give an idea of how much you lose per month of lack of activity, what is the contribution of various sectors. I think the CSO could be put to work to give the market some certainty. But let me ask the market man himself, who has to make these decisions of buy and sell on a daily basis. Hitendra, do you think the government announcing a borrowing program has introduced some certainty or uncertainty? How are you looking at that extra borrowing number?
Yeah, hi, morning, Lata. I think it would have been quite, I find it almost certain that everybody in the financial markets, whichever market one is a participant in, was expecting an increase. It is unusual to expect the kind of economic activity we saw in April, possibly even in May, expected to, slowly inch up from June and not to have any impact on revenues. I'm not even getting into the stepped up expenditure, because apart from the initial announcements in March, we haven't really got anything else. So from a additional borrowing perspective, my own sense is this amount, I personally feel, is at the lower end of most people's expectations. I have been watching and reading many articles by many eminent people who have asked for a significantly higher level of fiscal stimulus, adding incrementally, people are talking of between 5 to 10% or so. And the number that we have received of the additional borrowing program clearly is at the lower end of that spectrum, not lower than the lower end of that spectrum. So from an expectation perspective, I think almost everybody in the market was expecting. Timing-wise, we could debate, but I think the key issue from a market perspective that people will look for is how is it planned to be funded? Is it going to be entirely left to the market to fund and therefore prices to adjust? Is the central bank expected to play a more active role, or will they do it slightly behind the scenes kind of a role? I think that's what the market would seek clarity for. Per se, my own sense is, the previous three speakers all spoke about GDP growth rate, and we've had the spectrum of range. I think the market gets it, right? The market gets that the economy is in trouble. We can keep debating the extent of that trouble, whether it is 0 or 0.6 or minus whatever. But if you're having this kind of growth rate, and let's face it, most of us in our adult life have not seen a rate of growth of this nature. I think it's not that the fixed income market is going to be, or the FX market, or is going to be stuck in some dogma of its own that, you cannot increase borrowings irrespective of what happens. No. So I think it's got to be linked to growth. We can keep debating the extent of the economic damage, but that it is going to cause damages cannot be.
No, Hitendra, my question to you is that if the government had accompanied its borrowing program with an estimate of the tax reduction it expects and the extent to which it's assuming expenditure compression, do you think the markets would have reacted more positively? I mean, would it have been easy for a foreign investor perhaps to buy Indian bonds because you were able to put some kind of estimates? We saw the bond yields jump by about 20 basis points, and then they've come back to about, they're still higher by about 12, 15 basis points. Do you think that it would have been better to give estimates so that, bond yields fall? It's easier for economic activity.
I think, if this was a yes-no question, I would say yes. But the reality is, and I have I'd agree a little bit with just the immediate previous speaker, that frankly, data availability everyone is struggling with right now. I think it's if I were to be the one determining what is going to be the extent of the revenue foregone, it's very difficult to know when car sales will start picking up, when consumer sales will start picking up, and normal activity will, so I think there could have been two options. One is take a best case guesstimate and put it out there that this is the extent of revenue loss we are expecting.
Okay.
And then a year later or 6 months later, go in for a series of revisions, because this, whatever anybody's putting out there, GDP growth, tax revenue, inflation, everything is going to undergo significant changes as incoming data comes in. So I think the call is to wait for greater clarity and at least come out with an estimate where you have reasonable confidence, or go out there with a low confidence number, but at least have a number out there. I think from a financial market perspective, most of us are doing our own calculations. So it would have been good to get a bit of validation, but I don't think anybody is going to buy the argument or the numbers that, tax revenue is only going to be marginally lower or whatever. So that information might have been useful, but I don't think bond yields would have reacted any differently. I mean, it's just a question of demand and supply. Now we know the supply number has gone up by X. Whatever it caused it, whether it was due to revenues being lower than expected or expenditure being stepped up to meet the needs of the economy, the bond supply is the bond supply. I don't think the market would have reacted any differently.
Okay.
I think the only factor that the market, sorry, if I can just complete the point, the only factor that the market would have liked in an ideal situation is what is going to be the stance of the central bank in helping meet some of this stepped up supply. And apart from that, I don't think the market would have reacted any differently, even if we knew what the tax foregone was.
Oh yes, it's indeed bewildering that the central bank did not come and say that they will help in the borrowing program, or nor did it announce any OMO calendar, which was a bit of a surprise for many market people. But the other point which the market has been waiting for and has not been getting is any set of fiscal steps from the government. Why is the government silent? Is it that it is worrying too much about rating agencies? Should it? Those questions in a minute after this break. Welcome back. One of the factors or one of the expectations of the market have been some kind of fiscal announcements from the government, which hasn't come. We did get in the last week of March a humanitarian package of some 500 rupees for every woman Jan Dhan account holder, but thereafter we haven't got any. What should we expect? What can the government reasonably do given the constraints of the fisc? That question now to our experts. Anant Nageshwaran, that question really is to you. Is it not about high time that the government announced something in terms of at least the most vulnerable segments, a little more for Jan Dhan holders or the lowest level of the economy, something for the MSME sector, even if it were all contingent liabilities, because that section is so vulnerable?
Yeah, I mean, at the outset, I am as much an outsider as you are in terms of looking at what the government is deciding. So I have no idea as to why we are still waiting for a package. I mean, in general, the sooner we resolve the uncertainty, even if the package comes in smaller increments, that would be useful. So I'm sure, but the point is, it is not as though the government is unaware of the demands of the public, the business community, the people, etc. So and obviously, in the absence of communication from their side, we have no idea as to what is holding it back. So we can only guess at this point in time, and your guess is as good as mine. But yeah, in principle, I would say the longer the time it takes for fiscal support measures to come through, the greater is going to be the uncertainty, and that itself will have its own ramifications on future activity, the resumption of activity, etc. So in that sense, I agree that the sooner we have something, the better.
Okay. No, but under the circumstances, what would be your, your wish list? We know we cannot have an elaborate wish list because the taxpayer also is constrained. So what would, what would a minimalist list be from the government and the RBI?
Yeah, I think we have also sort of discussed this the last time we met. I think clearly businesses need working capital to meet their fixed obligations to the extent those fixed obligations cannot be postponed or renegotiated, which is mostly the statutory obligations and also payments to workers. So clearly that much is required for them to be able to keep themselves in the running, so to speak, so that when normal economic activity resumes within the country and outside, they can go in. So clearly we do need a support package for those businesses which are otherwise viable to be able to continue to keep their workers, because if you lose them, not only it is bad for the workers, but also for the skills and the experience that go out with them. So clearly that is the fundamental requirement for businesses of all sizes. And I would also mention here that we shouldn't be focusing only on the MSMEs much as they are important, because the larger businesses are the ones that support the ecosystem.
Yes.
So we do need to make sure that viable businesses of all sizes are allowed to remain viable. That would be my first and most important item on the wish list.
Okay, that may also be seen as pro-rich, isn't it? Maybe very difficult for the government.
Yeah, it's not pro-rich or pro-poor, and the government has indeed announced the first set of measures aimed at the smaller or the vulnerable segments of the population. Now, if you have an establishment with 30,000 workers, and if they are unable to make the salary payments, and if 30,000 of them are either going to become unemployed or 15,000 of them at least or whatever, their standards of living coming down from X level to a fraction of that X level has a much bigger impact on poverty and the national economic activity. So it is a question of making sure that we do not create poverty where none exists, even as we want to support those who are already poor. So it shouldn't be the case that we actually kill the viable parts of the economy. Sure. That will keep the system going for in the medium term as well. So it is an important consideration to keep in mind.
Okay, fair point. Well, Hitendra, I wanted to ask you, one of the constraints appears to be that, the rating agencies may put India under rating watch. Sonal has written that she fears Fitch may put India under negative outlook, not necessarily a rating downgrade. Will that be extremely bad for those raising money or those who have already raised?
So I'll answer this question in three different ways. One is, I would say what needs to be done for the economy has to be done for the economy. I think we cannot allow people to become unemployed or suffer from poverty or businesses to go down.
True, but we still need to know the cost. But we still need to know the cost if the rating changes.
Yeah. So let me just so my position is we should do what is right for the economy. If it causes a downgrade, it causes a downgrade. I think the second thing is the rating agencies, just as I previously mentioned about financial markets, are not, clearly they use logic and they use common sense. And as long as you are explaining to them what the context of the package is, why it's done, and how it will be refinanced and how it will be rolled out over the next 4 or 5 years in terms of repayments, etc. I think there is a case to be there. I think the final part I would say is I think we might overstate the importance of investment decisions taken by investors when they choose to come to a country like India. If you see bulk of the flows in FDI, I would think a single digit might be impacted by what the country's rating is. Bulk of the flows in equities, I think most companies in India are not rated investment grade, to be very honest, but they continue to get a lot of investment flows. On the debt flows, where maybe the ratings have a larger role to play, I mean, the reality is the amount of debt that international investors have bought of Indian paper is very moderate, A, because of local regulations, B, because of their own risk appetite and other parameters. So I think this whole debate about rating agencies and downgrade and the consequences, etc., I really think that should not stop us from doing. If the sense is we should do some, I'm not advocating for a massive stimulus, that's not the point, but I'm thinking if that's what the decision the policymakers arrive at, then that's what we do, because your focus has to be on the 70, 80, 90, 100 crore people of India who are affected by the current situation, and not by a bunch of analysts who I think might take
I don't think that is the aim of the government either. They just want to avoid the serious negative costs of a rating.
So which is the point I'm making, Lata, that the cost might be overstated and misunderstood by a lot of people, and I hope even policymakers also try and understand, there's $40 billion of FDI that comes into the country every year for the last so many years. I am sure most of those companies don't even know the credit rating.
Fair enough.
Okay, so it's, when you do FDI, you do it for bigger reasons because the market is here or low cost of production, and those things don't change.
Okay.
I mean, the amount of money which is coming to Indian equities, whatever it's $300, $400 billion at market value, if not more. I think all of that is because they find the growth prospects of India. And if you do the right package, which retains the growth package, I think you can live with, assume $20 billion of debt will outflow. I mean, that's okay in the grander scheme of things.
Okay, no, I would assume the government is also worried about $225 billion of ECBs that's out in the market over there, and what happens if that is not rolled over. But that discussion later. We're running out of time. So, the same question that I asked Anant, I want to ask Samiran and Sonal. Samiran, given the constraints of the government and the Reserve Bank, what can be a minimalist set of steps that they can announce, especially on the finance side, where there is a big fear of a credit event?
Yeah, Lata, I think the size and scope of the fiscal stimulus is going to be a function of what the government estimate of the GDP growth is going to be. And as that estimate evolves over time, I think the size of the stimulus will have to be adjusted in line with it. So this will come in tranches. In our view, there are 4 parts to it. The first part is a health and humanitarian support. The second part is an income support. The third part is support to MSME through a credit scheme. And the fourth is support for vulnerable industries. And I will put the priority list in that order only. The challenge is more on designing these schemes so that you get the maximum bang for the buck. Our sense is right now there is space for about 2% of GDP worth of fiscal stimulus immediately. But if we need to do more, we have to think of innovative means like a separate COVID budget, which would probably be funded directly by RBI with an explicit time frame of getting wound up over a 2-3 year period. So right now, start with about 2% of GDP and then see how the overall GDP growth pans out and how much of that elastic band effect that I was talking of, how much of that takes place in the next 2 quarters, and depending upon that, tailor the fiscal stimulus going forward.
Anand, from you, for the financial sector in particular, you think a further moratorium, permission to restructure loans for the next 1 year, and bad bank?
I think it is time, just as we are seeing quite a few state governments biting the bullets on contentious or difficult reforms, like opening up the farming sector to direct marketing and also labor reforms, the union government should also use this opportunity to talk about what you mentioned as the bad bank, restructuring of loans, and making sure that the NPA cycle is broken. Of course, it can be broken only if you also fix underlying issues such as sanctity of contracts, pricing of power, and electricity boards' behavior, etc. But I think besides the working capital and cash flow issue I mentioned, this is a wonderful opportunity to fix the financial sector issues, and that would be the second item on my wish list.
Okay, thank you very much, gentlemen. I think this discussion has definitely given birth to one very important idea, that the NPA cycle needs to be broken, and the bad bank idea, which is already germinated with the Indian Banks Association, needs to be picked up and encouraged by the government as well. And the other important point that Anand mentioned, sanctity of contract. If in some way this crisis teaches us how to ensure the sanctity of contracts, I think we will have fewer assets becoming bad. Thank you very much, Sonal, Samiran, Anand and Hitendra.